This time we've got David. David is 1,500 in the bank, and David buys 1,000 cans of Coke for €1 each. He buys a stall for 1,500, but this time he's going to fund that with a bank loan. So he goes to the football match, and this time he buys the permit, but he doesn't have to pay for stall hire. And he sells his 600 cans at €2 each. So let's look at our balance sheets. Again, the only thing he had at the start was the 1,500 cash. And the business owed him back the 1,500 cash, so that's his capital. He started to trade and he sold for 600 cans at €2 a pop, that's 1,200. He used up 600 cans that cost him €1 each, so that's 600 cost of goods sold. He spent €50 on a permit, and we're putting in €50 depreciation because his stall is going to last 30 matches, and 1,500 divided by 30 is 50. So he made €500. Now we look at his cash. He borrowed 1,500 from the bank. Now the reason I have these in the sequence I have is so that I'm lining them up so that you can kind of see what's happening from balance sheet to balance sheet. But 1,500 came in plus 1,500. 1,500 went out for the stall minus 1,000. 1,000 went out, sorry, minus 1,500. 1,000 went out for the cans minus 1,000. And 50 went out for the permit. So 15, 25, 2550. And then 27 came in. So the cash here is up 150. So we look at the balance sheet. My assets have increased, or David's assets have increased by 1,500, less the depreciation of 50. So 1,450 in assets. The stocks, he's got 400 unused cans at €1 a piece, which he'll use for the next match. Nobody owes him money. And now he has 1,650 in the bank. And the 1,600 came from the cash that was generated plus the original 1,500. So that's the 1,650. He owes the bank 1,500. And I should be saying the business owes the bank. You should be thinking of him and the business separately, because the business owes him back his 1,500. So that's 3,000. And he made 500 profit. So that's 3,500. So now he's got assets of 3,500. But he's got liabilities and equity of 3,500. So balance sheet balances. His cash is up by 150. His net worth is up by 150. The net worth is explained by the profit and loss. The cash is explained by the cash flow statement. So the key point to make is the balance sheet is like a photograph at a point in time. What did he have? What did the business have? What did the business owe? And then at the end, what did the business have? What did the business owe? The difference between the two of those is measured by the profit and loss. The profit and loss relates to a period in time. It can be a month, a week, but it's not like a photograph. It summarizes transactions over a period of time. The cash flow is an important statement. Cash is part of the balance sheet. It's an asset, or if it's an overdraft, it's a liability, but cash is, we'd say, part of the balance sheet. And you want to understand the movement of your cash. No business can survive without cash. So even if you're making a profit, you need to, in the long term, businesses need to be generating cash. They need to be paying back their loans. They need to be paying back their owners. And profits and cash are not the exact same thing. So that's it finished. I hope you found that useful. My name is Jim Cahill. I have an accounting practice in Galway called Accounts Plus. I help people understand their accounts and use that accounting information to improve profitability and to improve growth. My mobile and email are available on the website anyway, but the mobile is 086 23 23 525 and the email is jim@accountsplus.ie. Feel free to leave comments on this blog post. I'd be very interested in your feedback and if there's anything else you want me to cover. The blogs are found here. Now you're probably on this page already, but www.accountsplus.ie/blog. And if you're interested in this blog and want to look at some others, one that most people find useful is one called The Nuts and Bolts of Accounting. I think that's a useful blog to start with. So once again, thanks for taking the time to watch this, and I hope you found it useful.